Right. I declare the Audit and Risk and Finance meeting ARF 24/4 open and welcome everyone present. And after all that frivolity that was going on over here, I think we need to do our karakia again. Settle the spirit, clear the mind, prepare the body to achieve what needs to be achieved. Yes. Right, and apologies from Councillor Wickers. Thank you, Councillor Thwaites. Seconded Councillor Sol. All those in favour? Against, carried. Right, so our first report is from insurance people. Are they online yet?
Hey, good afternoon, everyone. Just through the chair, so we will invite Aon Insurance to give an update on our renewal of our insurance process that we've been through over the last 3 months now, and that's coming to a conclusion with some of those details highlighted in their presentation, which has been attached and which Matthew Wilson will take us through shortly.
Welcome, Matthew.
Hello, can you hear me all?
Yes.
Sorry, just bear with me a second, it's quite quiet. Okay, thank you for the invite. I do have a wee presentation to run through, so if that's okay with you, I will share the screen. This is a conversation, it's a brief summary of what happened in the insurance market over the last 12 months and where we got to with the renewal. I don't know if this has been circulated to you or not.
Yes, we've seen it.
Okay, all right. If there's any questions as we go, if you could sing out, and then I'm happy to answer them as we go. And please forgive me, Mr. Chair, or whoever the chairperson is, if I don't go through the protocol sometimes when I'm answering the question. So if I can share a screen with you, that one, and I'll put that into full size. So hopefully you can see that now.
Nope.
Sorry, was that a yes?
No, we still got you.
Okay. I do beg your pardon.
Yeah, we can follow on our screens if you want to. Tell us what page.
Well, if we just start, yeah, okay. If we just start on the first page with the introduction piece. So the Western Bay Plenty renewal outcomes, if we just start on the first 2 pages are really just an introduction. So on the second page, you've got my unfortunate VISOG there. My name is Matthew Wilson. I'm the National Manager for Aon's Local Government Risk Practice Group. Aon represent a number of councils in the local government space. So that is my role. I'm just actually trying to see if I can share this now, I think. Is that working now?
Yep, there we go.
There, got it. Excellent. Okay, I'll just put that into full screen mode. Right. So that's me. I apologise for not being able to be there today. The logistics just didn't map out, and we've got a couple of people off sick. So I do apologise for that. The intention was to be there. What we will talk about today is a brief summary of where the current insurance market is, and also an overview of the renewal outcomes. We have provided quite a lot of information through on this already, so hopefully you've seen some of this previously. But we'll go through the market. Excuse me. So the picture there is of the Lloyd's building in London. And the reason we put that one there is we have utilised offshore placements for a number of years on the council programmes. This isn't specific to yourselves, but we do utilise these offshore markets and we do go and visit these markets every year. And I will go through some of the benefits that brings to you.
Matthew, you haven't stepped through Well, what we're seeing is still your picture. So
Oh. Okay, sorry. All right, well, obviously I'm having an issue here because it says I'm sharing. Right. What are you seeing now?
yeah, market update when your
Okay,
outcomes.
all right.
You haven't gone full screen. That may be the problem.
No. Now? Is that full screen for you?
No.
All right. I've obviously got a hitch here, so I will, if you have got a paper copy, I do apologize. If you have got a paper copy in front of
Yep.
you, we'll do it that way.
Okay. That's
I
all
shall
good.
stop sharing. Minimize that. Stop share. So I do apologize. I don't know what's
That's right.
happened there. What I will need to do is just open up a small version of this to prompt me. So if you go to section 1, market update, you'll see a picture of the Lloyd's building. As I say, we utilize offshore markets quite significantly in the program, and I will come on to some of the reasons why and some of the benefits that gives to you. If you go to the next page, which is Global Events Overview. Now, this in itself is probably nothing new in terms of commentary. The bulk of your premium spend is primarily in 3 policies. That is your material damage and business interruption, your infrastructure, so your reticulation assets, and also your liabilities. Whilst you do obviously have other insurances that you purchase, the bulk of your premium spend is in those 3. For the infrastructure and material damage policies, so for the material damage, if you think your above ground assets, the driver in the insurance market for the last probably 6 years, well, if we go back about 6 years, the driver in the market would have been earthquake type events. They tend to lead to the large losses, the big dollar value losses. But what we have seen over the last 3 to 4 years is a shift in that driver, and that driver is now what are referred to in the market as secondary natural catastrophe events, which is primarily weather. So we're talking about flood, we're talking about drought, windstorm, and obviously we've seen these in New Zealand. Cyclone Gabriel, the Auckland anniversary flooding events, and others. They are now the primary drivers in the insurance market. And if you go to the next slide, please, the global market overview, this is just referencing how insurers are looking at those because there is an increase in frequency and severity of these events. This is why, or one of the reasons why we utilize offshore markets for you. Whilst those markets are exposed to these events, we're able to spread the risk across the entire insurance market, and you are less reliant on 1 or 2 insurers for the placements. Now, when the anniversary floods happened and Cyclone Gabriel happened, we saw insurers, domestic insurers or local insurers in New Zealand, I should say, put on restrictive terms and conditions. They increased excesses, they looked at rating increases. So that was a result of the increase in frequency and severity of those events. When we go, if you go to the next slide, renewal marketing presentations, please. We collect information from Peter and other people at the council leading up to September. Your renewal program is 1 November. And we go and visit with a representative of the BOP councils. We go and visit a number of markets. And just as an idea of the number of markets, so for your material damage, we spoke with 6 local markets, 2 markets in Singapore, and probably about 9 markets in London to see if there was any interest in London. We then spoke to 3 local markets for the infrastructure, so your below ground assets, 5 markets in Singapore, and that picture is of the team presenting in Singapore to underwriters, one group of underwriters. About 24 markets in London, and there's also a Bermudan market that's involved, but we don't go to Bermuda, that's done through London. And then for the liabilities, there's again numerous local markets, a couple of Australian markets that we deal with directly from New Zealand, but also we presented to 7 different markets in London. I will cover off the liabilities as a section on this presentation in itself. Why do we do this? Well, we do need the global market support. It makes your programs more stable, in that if everything is relied upon by a single or 1 or 2 New Zealand insurers and they decide they're going to do something with their rates or terms and conditions, we build competitive tension into the placements, which means if you've got more and more people wanting to write the insurance, then we can discuss and negotiate with those markets to get the best terms for you. Are there any questions so far? No? Okay. So what does this actually mean? Well, so I'm now on to the renewal outcomes. I've been working with councils for probably getting on for 12, 13 years. And during all of that time that I've worked with councils, or certainly for the last 7 years, we have been in what is called a hard market. And that means that the rates are increasing. And also, oh, thank you. Somebody's put the thing up for me. Thank you. Rates are increasing and terms and conditions are getting worse, as in the insurers are being more restrictive. This year is the first year in that period that we have started to see the market turn. For your material damage program, the underlying rate percent that the insurer charged by way of calculating a premium, so your premiums, simplistically put, your premiums are calculated on a rate percent multiplied by your total declared values. Excuse me. So this year, those rates were effectively flat. There were a couple of occasions where they changed very slightly, but they were effectively flat. There was no rating increase. And as I say, that's the first time we've seen that in about, well, at least 5 years, probably longer. Why is that changing? It's just a market cycle. These things happen. I don't think we will see a huge shift in that position. I think the rates will start to ease over the next couple of years, but we're certainly not going to see, unless anything radically changes, situations where you're getting sort of 15, 20% rating reductions. I think the rates will ease and they may come down incrementally in sort of 5% increments over the next 3-4 years. But it's nice to be able to report good news. There's been no change in the deductible levels and no change in the terms and conditions. You purchase your insurance program as part of the bigger BOPLAS group, and that brings economies of scale for you. So the total declared values that we had for the Bay of Plenty group were those numbers there, the 4.894. That generated a premium pool of around about $8.7 million. Now, yes, I know that's gone up from what it was the previous year, and I've said the rates are flat, but that's a function of those declared values increasing. But for yourselves, your values moved. We've been speaking to councils about, excuse me, making sure valuations are correct, but also a piece around asset selection. Have you gone through and looked at everything that you currently insure, and do you need to insure everything? Is there anything you can not insure or isn't required anymore or has changed? So that's a process we talk to councils about. So the net result for yourselves, for your premium, excluding the levies, which we have no control over, their government levies, there was a reduction in your premium year on year from last year. And as I say, that's probably one of the few times in the last few years I've been able to report that back. I will come on to something a little bit later on about why we should continue doing the work that we have been doing with councils. If we could please go to the next slide. Your infrastructure. Now, your infrastructure placement is largely done out of the London markets and has been for about 10 years, 10 years plus. We have collectively with yourselves, the Botplass councils and other councils, a very good relationship with the London markets. The London markets are slightly ahead of where the New Zealand markets are this year in terms of we are starting to see actual rating reductions. They are not huge, but it's certainly going in that direction. The underlying rate is going down. You did have an increase in your, the values changed for this year. You've seen a saving in premium. And if you look at the change in values from 23 to 24, that was a reduction of around about 16%, but you saw around about a 20% premium reduction, which means we've had an effective rating reduction of 4%. So it actually works out to be about 4.2 something, if I do it exactly. But it is a rating reduction. These are coming down, and our expectation is that the London markets will continue in that manner for the next wee while. There is one caveat that I always will have to say to this. On one of the previous slides, we spoke about secondary natural catastrophes. Whilst the market is in that phase where it's easing, if we have another major event, I'm not sure what the market response will be. So if we have another Cyclone Gabriel, is it going to continue to ease? Not sure of the answer to that question. I think we'd have to see if it happened, but touch wood, the last 12 months have been relatively good for that on a global basis, even though there's been some big events in the world. It's been relatively good compared to previous years. If that continues in that way, we would expect that your infrastructure premiums will continue to see a rating reduction, which again is good news.
Right, thank you. Matthew, can we just hold you for a moment there?
Through the chair, I just wanted to provide you with a bit more detail about the declared value decreases. I can see that Rodney was perking his ears up, what's going on, that wouldn't normally be the case. But I just wanted to let you know that I've had 2 new staff on board in my asset solution area, and obviously Peter, who's looking after risk and assurance. Peter's very experienced in insurance matters, and our asset solution lead, Corinne, is an accountant by trade, but also very good with the asset management side of things. So we undertook a deep dive into the infrastructure assets this year, did a review on what we had, the replacement values, and the whole work. So there had been for a number of years just an assumption about what the value increase was, as opposed to doing that deep dive. So they did a great job, and so I'm very comfortable and do have a reconciliation if anyone wants to have a look at it.
You anticipated my question very well. So we were basically over-insured before.
Oh, thanks. Just a couple of questions on that. That was one of them, was that for infrastructure and for material damage, this council has seen a decrease, but we've seen in the case of infrastructure, our values decreased. So therefore, the insurable value has gone down. I don't know how much of an influence that's had on our reduction in premium. But have we had any changes to exclusions? Have we had any changes to excess? And has there been any significant terms and condition changes that mean that we're not comparing apples with apples when it comes to what it is our renewal outcome is actually providing us?
If I may, through the chair, the short answer to that question is no. Colleagues of mine who dealt with the infrastructure placement have provided commentary through to Peter. There's been no changes from that aspect. What you are seeing is that reduction in premium is as a result of the prudent work done around the asset piece that was alluded to, and also that underlying rating reduction that is taking place in the market. We have seen some councils, not in this geography, but just to give you some reassurance, we've seen some councils who have been able to increase their limits because we buy loss limits on these programs. We've seen some councils be able to buy an increase in limit for a similar premium than they paid last year. It's just down to a market cycle at the moment, and the good work that has been done over the years around the quality of information going to the insurance markets, the asset selection piece, the reviewing asset schedules. Insurers have more confidence that the information they are obtaining is correct, and that long-term relationship that we have with the markets and your support of those markets over the years.
Right, thank you. That's the questions at this stage.
Okay. If we could go to, no, there should be one for liabilities. So keep going forward about 3 slides, I think. Keep going. Liabilities. This is a different story. The liability, so what we're talking about here is your professional indemnity and public liability covers. This is a stressed purchase in the market for councils. This is not a specific comment to yourselves. This is a comment about the sector. There are few insurers in New Zealand who want to write local authority business. There's somewhat limited appetite. Your current insurer or your current lead insurer has made a commitment to the local authority space. And they've been our lead insurer on this program for a number of years now, about 4 or 5 years. They're committed to the space. There was a slight rating increase this year, which was in line with what we were expecting. The big issue that we have for local authorities currently is claims relating to building consents. From a professional indemnity point of view, most of the claims we see in the sector relate from issues around building consenting. In order to maintain that long-term sustainability to this placement, the insurers wanted to put an annual aggregate cap of $30 million across a group of 37 councils, and I'll detail those councils in a second, of 37 councils of $30 million. We were able to negotiate that up to $45 million. So what that means is the most that insurer will pay in any one year for claims relating to building consent issues or Building Act issues, I should say, is $45 million. It is not an ideal situation, and we are continuing to work with some other markets about a possible solution to that, but it is taking some time. I do show a list of the councils in a second. The important and really important point to note here is the list of 37 councils does not include Auckland City or Wellington. So these are largely smaller city councils and provincial councils. The claims stats do not suggest that that $45 million is a problem in terms of overall value of claims that have been incurred across that group of councils. However, it is there, it is on the program, and at the moment we can't do anything about removing that from the program. That is what the lead insurer has said they wanted. But we are looking to see if there are possible ways of potentially buying, if you wished, additional cover to protect that aggregate position for yourselves. That is a work in progress, I'm afraid, at the moment.
Right, thanks, Matthew. Got one question on that one?
Yes.
So you partly covered it. you've talked about the claims history. Any idea where, and I'm sure it's fairly volatile, but what level does the claims history suggest as being the history for this across the 37 councils?
Yeah, the largest single claim we've had, and I'd be careful about what I say here, but the largest single claim we have is about $13 million. And I'm not going to name names as to who that was, but a council claim for Building Act issues was about $13 million. The average claim, so, okay, we went to London to present to the markets about your excess layer, which I come on to in a second, but I can answer your question through this. I put together claim stats for the 37 councils. Because mostly you are provincial councils, and I don't mean that in a disingenuous way, but we're not talking about an Auckland and a Wellington. There are different types of building consents. There's Res 1, Res 2, Residential 1, Residential 2, Residential 3, and then there's Commercial 1, Commercial 2, Commercial 3. Depending on what type of consent you issue, and your building team will be able to tell you far more about this than I can, that sort of frames what the type of property is. So the issues in this space have come from either large commercial properties or multi-unit, sort of flats, blocks of flats, multi-unit type properties. The vast majority of councils in this group of 37, and I can't remember the exact number off the top of my head, but it was something like 62, 63% of the consents issued by that group of 37 councils, they were Residential 1. And Residential 1 is basically a domestic house. Because of that, the actual value of a single loss, let's say you're consenting on $1 million property and there's something completely wrong with it and it has to be started again, the value of that claim is about $1 million or less in reality. You don't, as a group, have many situations where you are consenting on big multi-unit or big complex commercial. So what we see is for this group, is lots of little claims, which is why that 45 million should be a sufficient figure in terms of the aggregate across the 37 councils.
I guess my question was more, what is the aggregate claims per year across that group? Yeah. When you've done your analysis, what's the number worked out to be? Yeah, a range between X and... I
would have to refer back to it, but it was probably in around about the 5 to 7.5 million number.
Right, okay.
I wouldn't like to be quoted on that, though, if I'm honest. I can provide subsequent information for you.
It was an indicator. It gives an idea of the scale between that and the 30 and the 45, yep. Right? Yep. And leaky buildings, is that still a factor in any of this, or is it more?
Well, leaky buildings are excluded and have been for some time. The thing the insurer is concerned about is effectively the next one of those, is the next systemic issue that may arise, which will impact multiple councils all at once. I can talk about this because it's out there. So one of the key decision, I guess is the word, you may be familiar or not with Risk Pool versus Napier City Council. So Risk Pool used to provide liability insurance to councils many, many years ago, and they had a building defect exclusion on their policy. The building defect exclusion is basically around weather tightness issues or water, rot, mold, mildew, water penetration, those sort of things. It is a standard accepted exclusion under these policies and has been there for a number of years. The Napier Risk Pool decision is around whether a property is excluded for building defects or not, if it is excluded because of the building defect exclusion. I've not explained that very well. I'll try a bit better. What I mean by that is a claim is presented and the primary issue with the building, let's say, is a weather tightness issue as defined by the building defect exclusion. That does not mean that any secondary or tertiary issues with that building that are not directly linked to the primary issue, the weather tightness, or that, I should be careful not saying weather tightness, the building defect exclusion in the policy. That does not mean that those secondary and tertiary issues are excluded. That is the way that the insurers that we use for your insurance interpret that exclusion. So you can have a building that presents to an insurer with absolutely excluded items because of that defects exclusion, but then secondary or tertiary items that aren't related, and the insurer will look and consider those as a claim. What risk pool were doing was saying if the building is excluded because of that primary exclusion, then any secondary and tertiary issues are also excluded because they excluded the building and not the issue. That decision was overturned in the case Rispel versus Napier, where the courts basically said, no, that's wrong. Yes, those defined ones are excluded, but the secondary and tertiary issues should not be excluded and can be claimable. Does that make, I hope that makes sense. I didn't do that very well. Yep.
So one more question, and I'll try and make it a simple one. So you've talked about we may need top-up cover. I mean, bearing in mind we are mainly residential, what would trigger the need for top-up cover? Would it be something like a large industrial estate where we've got much bigger buildings, for example?
Well, potentially, or it could be that systemic type issue. If we have another, something like that, some other issue that is going to impact multiple councils, and then that aggregate is potentially exposed. Could we go to the next slide, please? So that is just a snapshot. I know it says 36. There is one to add to that, but the purpose for that is you can see the type of councils who are within this group. There isn't an Auckland, there isn't a Wellington. We don't act for Christchurch. Probably the biggest cities in there will be Dunedin, Hamilton, Tauranga. So it is largely all residential stuff.
One more question, Matthew.
Yes.
Hi, thanks, Matthew. Can I just some clarification and inside that maybe a couple of questions. At the moment, the pool that we belong to numbers how many councils?
It's 37 for yourselves.
Oh, no, I'm talking of Botplas.
Well, Botplas.
The first slide where we talked about the premium pool.
Yes, that is 9 off the top of my head.
9.
I have to go through the list.
But we've now got 37 councils, which we see here, and that in this category, liabilities, there's going to be a cap of 45 million.
Mm-hmm.
And I see that we've got in here a number of regional councils.
Yes.
And I'm aware of just one litigation at the moment that is in its own right. I think it could be to do with consent and construction and in relation to
Are you referring to a regional council?
Number, including a regional council, but
Okay.
I'm thinking in this that it's not shy of $45 million. I just don't. I mean, the premium that this council would pay in relation to this kind of cap, it's going to be relative to the 45 million of value that is being capped, shared amongst 37 councils. So I'd imagine that it's going to be a significantly lower premium because you're not getting really, we're just buying some insurance for $45 million worth of potential cover that we or collectively.
Well, if I may,
I'm just, yeah, can you clarify this for me? Because it's not sounding like a very good idea at the moment.
so you have your own policy for an amount of $15 million worth of general liability, public liability, an amount of $15 million for professional indemnity.
Yep.
That is rated on your claims history, your experience, your performance, and a premium is calculated for you.
Yep.
That $15 million is yours. That is not shared with anybody else. The aggregate cap relating to Building Act claims, because all of these other councils also buy a primary $15 million worth of cover. The aggregate cap for Building Act claims is spread across those 36, 37 councils. So if you have a claim, and at the time that you have that claim, there is no diminution of the aggregate cap for Building Act claims only. So whilst I've said that most of the claims we have are for Building Act claims, there are other claims, which is why I asked about the regional council question, and I'll come to that in a second. So yes, most of the claims we see are in relation to Building Act claims, but they tend to be, for this group of councils, they tend to be values less than $1 million, and most times they're less than $500,000 for this group of councils. So let's say day one of the policy, there is a claim submitted against yourselves. There is no diminution of that $45 million because we're on day one of the policy, and you have a claim for, let's say, $15 million. Your claim will, subject to policy terms and conditions, etc., etc. This is just an example. That claim is paid because you've got $15 million worth of cover. What it then means is that for the other councils in the group, including yourselves, the other councils in the group, there is then only going to be $30 million for Building Act claims available across that group because you've reduced it by 15 million because you've had that big claim. The risk with this at the moment, which is why we are trying to find a slightly different solution if we can, is that the Building Act aggregate gets eroded by other members of the group, and you potentially could have a claim, let's say, on the last day of the policy, and there isn't the full value of that claim available because the other councils have reduced the annual aggregate by having claims. What I will share with Peter is these claim stats, because that is a really, you can never say never, and I fully understand that, but the claims history over the last, I went back 10 years for the underwriters, the claims history over the last 10 years suggests that this is not, we're not for this group of councils going to get to that level, because the claims are that sort of $500,000 and less, $1 million and less number. But I do accept that this is not an ideal solution or an ideal situation, which is why we're trying to see if there's anything else that we can do. Now, it is only for Building Act claims, and Building Act claims are quite clearly defined within the policy. If there is a claim that relates to something which is not the Building Act, then this aggregate doesn't exist. You have $15 million worth of cover. I hope that, does that explain it?
Thanks, Matthew. And we might get staff to flesh this out a bit and bring back another report for us.
Yep. I can provide some
assistance
questions
rather than
yep.
spending the time on it now.
Sure. if we could go to the next slide,
Hang
because
on, maybe one more question before we do.
Just
Sorry.
wanted to say, sir, Mr. Wilson, we're a growth council, so our liability could actually be higher than some of these others that are listed here, who are much smaller, and we could therefore be quite a lot more vulnerable.
Well, I'm sure it's all been based on our previous risk level. I'm sure they've
Correct.
worked all that out in the background.
correct, which is again why we are trying to work on a possible solution for this aggregate cap to see if there's something we can do, which we are working on it. I don't particularly, I think this is perhaps the forum to go into it right now, but we are working on that and we will report back. I'm mindful of time. I don't know how long we've got, but what you also buy, and I think this is going to give some comfort to the reason why you have a primary 15 million, what you also buy is an excess layer placement, which is done out of the London markets. Again, it's a shared limit, and there's a very good reason why this is a shared limit. We buy an additional $145 million in excess of that primary 15 to give you, for a single event, you effectively have access to $160 million worth of public liability and or professional indemnity. So again, I think perhaps I ought to, I can provide some additional information on this to explain the mechanics there, if that is helpful. That particular placement was probably the hardest placement that we had in the entire council programme this year. You may or may not be aware, there were a number of councils who, come 30 June, not ones that Aon dealt with, but come 30 June this year, just gone, 30 June just gone, the London markets walked from a placement, which sent a bit of a shockwave through the markets. We were able to find cover for those councils who were impacted, and also their incumbent broker was able to find some cover for them as well. But it did send a bit of a shockwave through the London markets. Because we went to London, because we presented to London, because we put those claim stats in front of London that I alluded to earlier over the last 10 years and the difference in the different type of claims, we were able to secure this excess layer for you, which you'd had previously. I was actually quite concerned at one point that we wouldn't be able to get that because the London markets, some of them had made a sort of a carte blanche decision not to be involved in the local government sector anymore. It is an ongoing process, this one. We will, as part of the year coming forward, what we want to do and work with councils is have conversations about risk management around this space. What are the controls and processes so that we can present the very best to the London markets as this and other markets as this particular placement is getting quite stressed. But again, that's a work in progress. And this, again, I must stress, is not a comment about yourselves. This is a comment about the local government sector. This is how a lot of insurers are viewing the local government sector. If we could go to the next slide, please. For the other lines, again, mindful of time, for the other lines, everything was pretty much flat. Again, we've reported this back to Peter and others. Everything was pretty much flat, which is what we were expecting. And yeah, I think the outcome on those was as we were expecting them to be. Again, if we could go to the next slide, please, unless there's any questions. So what can we do moving forward? And again, I quite like this one. We went through a phase a few years ago.
Sorry, Matthew, we do have one question.
Oh, sorry.
It's actually more for staff, and it may be too early yet, but there is change coming in the building consent space, the Building Act space. Have we any indication of how that will affect our liability? Because that seems to be the biggest issue. If building consents leave the council and we're left with the liability, that's a hell of an argument, isn't it?
Through the chair, Matthew might be able to answer that, but we're obviously monitoring all the changes, and Matthew basically spoke to that earlier. we've kind of come off one era of building and then into another era of building, and some of those unknowns. So I was involved with the risk pool case when I was down in Napier, so I do know the circumstances very well. But yes, it's definitely a watching brief.
Yeah, 100% agree with that. It is a watching brief, and there's lots of people looking to see where that's going and how things might stack up.
So are
Well,
we participating in the process of the review? It's one thing for central government to be doing something. Are we trying to have an influence on it? Are you trying to have an influence, sir?
It's not our place to be involved in the review as such. I can't speak for council as to what the consultation process is. I do know there are a number of organisations sort of looking at this, but it's not something that we would be involved in the review of directly.
Right.
So what can we do? I mentioned earlier on that we've seen an easing of some of the rates. I'm not suggesting the world is all wonderful and rosy again, but we've seen an easing of some of the rates. When premiums were increasing, there was a lot of focus and attention given to what can we do to reduce cost. Just because we're starting to see a slowdown in some of the pricing in those material damage infrastructure and some of the other placements, doesn't mean we shouldn't continue to do the work that has been done up to date about understanding what your risks are, understanding your exposures, and still working through that process to make sure that the insurance program that is purchased at the end, that is purchased each year, is what you need, what you want, and fit for purpose. I'm not suggesting it isn't at the moment. Please don't think that. This is just an example of what we've been talking to councils about. And different councils are on different parts of this journey. But it is about continuing to do that work. And one of those pieces of work was alluded to earlier, where reviews of property schedules have been done and asset schedules and valuations, and how you're comfortable as an organisation with where you have landed on those numbers. That's just one step. There are other steps that can be done, and this is just a graphic that represents what some of those steps are. We will be talking to the council as we come into the new year about how, is there items within this process that we can do, we can look at, just to keep the momentum continuing, to make sure that any insurance program or any insurance related decisions are done with a good base framework, and we understand what the implications may or not be to those from your point of view as an organisation. So this is just a framework that we work within and work through, and it's iterative. It changes and is refined. Next slide, please, if there's no questions to that. Again, this is just another one of those things. What are the things that you can do? Do you have a risk appetite statement? Do you have a risk tolerance statement? Again, these are generic points. They're not specifically related to yourselves. Review each policy, make sure that it's fit, it's what you want. I mean, I've had some councils who have continued to purchase an insurance policy going over a number of years because they've always had it, and then when we've actually sat down and done that review, I don't think this is you because we've done this work over a few years, they decide they don't need it anymore. It's not required, the assets have gone or whatever it may be. So it's just a thing that we work through. One of the things that you can consider is levels of deductibles or excesses that are on the programs. Councils tend to have, by and large, a lower deductible than the equivalent, and I use the term loosely, please, the equivalent commercial entity, as it were. And there are a number of reasons, very valid reasons for that. But if you want to start looking at further refining, further making potential savings, the review of deductible levels can be done. We can have a look at what the impacts of those are for you. There has to be a cost benefit to it, and the potential increase in exposure versus the reduction in premium. Does one outweigh the other? Is it sufficient? But these are, again, ongoing conversations. The asset management piece that we've spoken about earlier, that's the selection piece. And I've spoken to Peter about this and others. This is, again, an ongoing piece of work. As your property schedules evolve and change, or properties are removed or come on, come off, or change, we just need to make sure that we're constantly reviewing that with you, and ensuring that everything is as it should be and what you want it to be.
Right, one more question on.
So, again, more for staff. Obviously, we've talked about number 4, asset management, we've done it. What about the other 3 in particular, the level of deductibles? I know it's only a small part of the equation, but I was kind of shocked to hear some of our halls have $500 deductibles and others have 5,000. I mean, these are real costs to ratepayers. So where are we up to with the other 3?
Through the chair, that's something that's next on our work program. So, it is definitely something for us to consider given the increase in costs, and we would want to drive down costs as well. So, what we had planned, and Matthew talked about it, is come back next year just to review where we're at for our next renewal cycle.
Right, so that just about wraps us up, does it, Matthew?
That does, yeah. There's basically just a slide talking about deductibles, but we've covered off most of it. So yeah, that's me.
One more question. Don?
Thanks, Matthew. I'm just asking for a friend. Is my home insurance likely to follow this path for the next couple of years?
No, probably not.
Oh, blast.
All right.
I know the feeling. If it makes you feel any better, I know the feeling.
Thank you very much, Matthew. Appreciate your time coming and giving us that report, and for the work that you do.
Sorry, Murray.
2 more questions, sorry.
Sorry, and I know this is a question I really wanted to ask looking forward, because there's going to be a number of things covered in this meeting which this will have a bearing on, and I'd really like your opinion as an overview, Matthew. Affordability in relation to insurance isn't just a council issue. It's a significant and probably one of the primary issues that council's making decisions on in relation to its community. And I think your question about the household mortgage, household insurance. My observation is that as a percentage of fixed costs of average incomes, insurance has absolutely gone through the roof. It's almost it's more than what a rateable property pays and rates. Now, we're in the business of trying to provide services, and you can't get blood out of a stone. And it strikes me that there's potentially a trend where non-mortgaged residents are becoming more inclined to not insure because they're constantly seeing the value increase on what they're having to insure, but their income level doesn't support that. And they're not given the option of being able to take out partial insurance. Now, are we seeing, because if whatever rateable property is faced with 2 big fixed costs, we'll just say 2 at the moment, rates from council, insurance for their property, and they're going to pay the council because everything is in place around why and how that should be paid. Are you starting to see a trend in New Zealand where particularly older and elderly owners of property, rateable property, that have not seen their incomes increase at all, but have seen the percentage to income of rate of insurance values really climb? Are you starting to see a trend towards non-insurance? Because if you've got a mortgage, you're going to have to do it anyway because the bank's going to require it of you. But it's this other part. And I think that's a really, it would be really good to know what's happening in the industry around this, because it's part of this whole affordability issue that everybody's grappling with in terms of solutions. So I'd really be interested to know what you're seeing as a trend.
It's actually quite difficult for me to answer because I don't personally, from what I do within the organisation, I don't have a huge amount of visibility on what the domestic market is doing and the take-up rates. What I can say is the long-term sustainability is absolutely a question that the people higher than myself within the market and these areas are looking at. I think it's a very valid question. What will happen with, and again, this is my opinion. I must stress that this is my opinion. Responding to the question in the manner in which it was answered, what is going to happen when we start seeing more and more issues potentially around climate change and areas becoming prone to flood on a regular basis, and managed retreat and all of these sort of things? I don't know the answer to your question, if I'm entirely honest, but I do know the industry is looking at that long-term sustainability. How is it going to work? For all the points that you raised, and that's probably about as much as I can comment on from my role within the organisation. It's a valid question, and I think there are a number of agencies probably grappling with it at the moment.
Okay, thank you. Got another. Deputy Mayor.
Yeah, my question was for staff, simply, when does our insurance year turn over, and when and how frequently do we pay our insurance bill?
Through the chair, so our premiums, as Matthew just pointed out, it's about a 3-month process to go to the global insurers, so they're effective from 1 November. So we'll be starting to think about then what does council want to do differently earlier in the year before we then go to market. So if that's where the direction comes from, we could have that conversation.
Yeah.
Thank you, Mr. Chair. My question is that during the long-term plan, which we signed off not so long ago, we baked in increases of 20% year on year, and that had been the historic norm for the last 5 or so years, I believe, and was the vision going forward as far as we were told. I probed that quite significantly because I thought anything going up 20% year on year is just not actually sustainable on a market basis or a customer basis. So the question is, do we need to look at our forecasts for the premiums through the annual plan process? Because clearly if it's flat or down this year, then 20% year on year is not looking like it's going to be met. That might be one more for staff than Aon, but
yeah, through the chair, it's certainly on our list of potential savings.
Great. Okay, thank you.
Tracy.
Well, I was just going to say to Stuart, I can actually answer that question around domestic insurance, but I don't have to do it in this forum. Yeah.
You can take that offline.
Pardon?
I said we can do that offline.
Yeah, that's what I'm saying. Yeah, do it later.
Okay. One last one for Grant then.
Matthew, you talk a lot about the London market, but can you comment on, like, there must be a lot of Middle East money, for example, maybe it's not a good politically correct to go there, but are there other markets? Singapore, I guess, is pretty safe, but are there alternatives? I mean, there must be a lot of money floating around that are prepared to invest in insurance.
Presumably these guys are the experts, they know what they're doing. That's why we employ them.
I mean, there's America as well, I don't know.
I can give a brief answer to that. The primary markets that we...
Matthew, sorry, we probably need to move on through
Yeah,
the
okay.
meeting. So
Sure.
thank you very much for your time.
No problem at
We're
all.
still going to get through a large agenda, but we'll follow up in the new year with regards to our future premiums and
Absolutely.
insurance requirements. Thank you.
Thank you very much.
Thank you, Matthew.
Bye-bye, everybody.
Right, thanks. Right.
And then,
All right,
Matthew.
so we have a, yeah, no, we have a, have a recommendation that the presentation from Aon Insurance be received. Thank you, Rodney and Alan. All those in favour? Gets carried. Right, we have our auditors online already, so we'll hand over to Jonathan or Adele to take us to 10.1 on the draft annual report. And welcome, Leon.
Welcome, Leon, and thank you, and through the chair. Apologies that this report was attached late. As you can imagine, this work has still been undertaken by Audit, and we wanted to give you the latest information because the purpose of this report coming to this committee is a recommendation for Audit to adopt the annual report, subject to any final audit changes. So it is my pleasure to be able to present this today. We do acknowledge that this is later than we would normally expect a council report to be adopted, but this was enabled under the Local Waters Done Well legislation, which provided for up to a 31 December adoption date. This was as a result of having our long-term plan take up the 3-month delay option, which then diverted the audit resources away from the annual report. But we are where we are today, and Leon has been supporting us getting to the final adoption, which is due to Council on the 12th of December. Given that this is the Audit and Risk Committee today, the primary reason is to talk about the financial position of Council, and so I would like to talk to the key financial highlights of the year for ending June 2023-24. The current economic environment during 23 and 24 has made this a challenging year for Council and the community. Inflation and cost increases were seen across the business. However, we note that the latest OCR rates show a decrease, and we're seeing some further improvements moving forward. And again, on the back of the insurance information, there's an upturn in other areas as well. What we did see throughout the year was the government signalled a 40% decrease in our building activity, and this was seen within our district with a decrease of 32% in building consents, 61% decrease in RI building consents, R1 building consents, and 19% reduction in resource consents. What we did was to take action and reduce our costs where possible. This flowed through into our reduction in our financial contributions, where we only achieved 90% of our budget. You will note that our rates revenue was also below budget due to an accrual in the prior year as a result of our water charges, but this does not affect the income between those 2 years. It was just a timing issue. And we did, because of the late adoption of last year's annual plan, we also issued our invoices late and therefore had a late uptake of our penalties, which reduced our penalty income. And we also saw an uptake in our rates remissions through some of our policies. Our financial position, and you'll see from the bottom line what was in deficit, and this impacted our operations control benchmark as a result of our cash funding. This was predominantly through the regulatory activity, which is a rate-funded activity of Council. A resolution will come to the formal council meeting on how this deficit can be managed in the 2024-25 year. But what we've signalled to council is that this is a $4.2 million rating deficit. You will not see it through the financial position because you will see our full annual report, including our vested assets, which is non-cash, our depreciation, which is only partly funded, etc. Council closed its financial year with a borrowing of $115 million, which was below our budget of $141 million. This was due to the capital program not being fully delivered. These projects have been carried forward into future years and delivered based on the timing of those projects and when they were, what year they've been put into. They have been transferred across the 3-year program. Council is still well positioned as a whole with a net debt to revenue ratio at 80% as it closed its financial year. Subsidies and grants were below budget, as picked up by our Deputy Chair, and so details are contained in Note 6, but predominantly that variance is a result of the timing of our Waka Kotahi subsidies. During the financial year, we wrote off assets for the Waihi Beach elder housing, and as a result of a decision not to rebuild due to being in a flood-prone area, resulting in a loss on these assets for the year. A redevelopment of the Karikari elder development is now in progress and will see an increase in the overall units of the portfolio in the future. We have obviously undertaken a lot of major projects, and those major projects have been discussed at the Projects and Monitoring Committee this morning. And a list of the achievements will no doubt be covered off as part of the annual report adoption in the council meeting. So I won't talk to the actual delivery of the projects, but I just wanted to give you key highlights on our financial performance, and happy to answer any questions that the committee might have, or they can also be directed to Leon or Anton, who are online from our auditors. Thank you.
No questions.
Oh, yeah.
Sure.
Sorry, I've got a bunch of questions, if it's okay, Mr. Chair. Some are just areas of clarification and some are suggestions, and they may have already been picked up with the auditors. But can we go to page? Well, I'll kick off on page 15, which is the finance summary overview. And that's the first place that we see the mention of the reported net deficit. It's been rounded up to 4.5 million there, compared with a budgeted operating surplus of 32.1 million. Now, if we look further in the graphs and we look at the numbers, as a reader, I'm thinking, hello, we've got operating expenditure of 142.3, and I have a look further and I see revenues 143.9. Now, I know that there's a difference here between operating revenue, i.e. revenue that excludes your developed contributions and other things, i.e. it's adjusted. But the reader doesn't know this, and the reader just sees, hold on, you've made a surplus, guys. What's this deficit? And I have to actually go to page 16. No, not 16. I've got to go to page 19 to actually get that detail. And I'd have to be an accountant to really understand that, or the nuance of it. I think it would be really healthy if the issue of the deficit was really upfronted. I think it should be mentioned. Personally, I feel it should be mentioned in the Mayor's report. And it's not about sugarcoating stuff, it's about explaining what it actually means in layman's language. Because I think the ratepayers would, or any reader of this, would just like to know. We know that there were issues and they are being addressed, but I think that in the very beginning of this report, there needs to be, I believe, a transparent focus and a comparison of apples with apples, so that when people think, and further along, this issue of definitions is, we've got definitions on revenues, we've got definitions, and we've got benchmarks. it's just always good to make sure that those definitions are holding true right through the story. That was my sort of opening comment and just observation on the cut and thrust of the report. If we go to page 16, I think, look, it's really good when you've got net debt per rateable property. I think it's a really, really relevant, and for any reader, it's the thing that they're always going to compare. They're going to compare, because they're doing it themselves, you know, they're thinking about themselves, and they're thinking, heck, I live in Western Bay of Plenty District Council, I've got Tauranga next to me. I've got Whakatane down the road, I've got, what is our net debt per rateable property compared like with our neighbours? It would be really good to have a comparative there. I think you'd actually look quite good, and I think you should be showing that because that's a really important number for people in their psyche. Otherwise, why would you put it there? There's sorry, I have to go to my notes, folks, and I have the problem that my mother had, and that she could never read my writing, and everybody has that same problem. I even have problems reading my own writing. On page 19, the big increase in terms of operating expenditure probably needs a mention. I think if we go to page 20 and we think about the measures and benchmarks, in that chart on page 20, my question, I guess, for clarification is net debt to total revenue, is that the definition that we use, for example, for LGFA, which is kind of one of those very importantly measurable ratios, or is it is revenue defined in the same way, I guess, and what figure should we really be showing if it's not?
Through the chair, it is the same as LGFA, and you'll see the definition is listed underneath the heading.
Sorry, the heading, can you guide me?
The rates affordability benchmarks that we're talking about, which is talking about less financial contributions, gains, invested assets.
Oh no, I'm on page 20. I haven't got to the, yeah, I see where I see that further on when we look at rates affordability benchmark, that's page 24, I think. I'm looking at page 20 where we've got net debt as a percentage of revenue and assets, and we've got three lines in there. We've got our external debt as a percentage of total assets. We've got the proportion of rates to total operating revenue, and I guess that would be operating revenue in the LGFA sense, or in our.
Through the chair, this is total operating and not the benchmark ones that are sitting elsewhere with the definitions.
Oh, yes, but I know that as we've got this here, if I'm reading this as the first chart and then I get to the benchmarks, this is my point: is are we talking about the same thing here in terms of net debt as a percentage of revenue and assets, i.e., is that net debt? And because when I'm looking at that, when I'm looking at the green line, I'm wanting to probably ensure that that green line is consistent with the other the other measurable benchmarks. I was just more of a check to say, is that the case? I hadn't done the numbers, Adele. Go to page 20. On page 24, which is where we first show a red line or a red bar, we might just want to put in there, in the key, that's red because it's actually a breach. We do that further on.
Stuart, is it worth you and Adele getting together on these?
Well, I think this is,
A heck of a lot of this is prescripted by, we're told what we have to report on and how.
sorry, I think you might be missing my point, Murray, somehow. Because this is a document that this committee is going to effectively say, yeah, go ahead, and I think some of those things that I'm talking about are for this committee, not for management so much. That's my my take on it. I'm not sure how others feel about that, but I've only got 2 more points, if you like, and if you can bear with me, that's. So, coming back to, I guess, my original comment, which was about the way that the report reads and the messaging that you're giving to your community through the report, I think that these benchmarks that are not, hitting the mark, do need to be upfronted, and that it needs to have a plain English explanation that takes the reader on a journey. I rather than refer to note 6, and we've got to get away from that. Is just my belief. So that's me done. Thanks very much, folks, on everything that I saw.
Thanks.
Yeah, I think that there's a balance between going through sort of typos and this sort of meeting and things of significance. I think you're probably a mix of the two there. I've got a list of things which I'll forward on after the meeting, editorial. But I think I will just sort of reinforce some of what Stuart said. Some of those graphs, for example, page 28, operations control benchmark, that's hard for anyone to understand, and also because there's a huge miss of the benchmark on that one, and I'm sure there's a very good reason, but it's not easily explained, and so I think there definitely needs to be some work on that. I think, but look, rather go through each graph one at a time. I think if we can agree that some of these things might need a little bit of further explanation, then we can take that offline and work that out afterwards.
And through the chair here, happy to do so.
Yeah.
Councillor Swaits.
Thank you. It was quite, excuse me, ironic that as Stuart was speaking, the Katikati Beach Residents and Ratepayers Association newsletter dropped on my desk too. But I certainly agree with them on elaborating a bit more on the deficit and how that goes in plain language. And it's funny Stuart sitting in that seat, because former Deputy Mayor Williams was a W and he sat in that exact chair, and he was a champion of debt per rateable property. It was like winding back the clock here as you speak. And he was a real champion of plain language explanation of intricate accounting, accrual accounting. So I just really wanted to make the comment because it was like Mike revisiting us, the ghost of council's past coming back. Not that he's passed on or anything, but he's not a ghost. But so anyway, that was just my comment on that. Well done, Stuart. It's a good reminder, and it's critical to explain it clearly and work on those key ratios, because it's way better now than it was when I walked in here 15 years ago. That's for sure. That number of debt per rateable property.
Councillor Sol.
Thank you, sir. Yeah, basically, I think what Stuart's really talking, which is something that in general, and it's something that I really believe in, is how you sell your report and how you present it to the people. And fronting things is usually better than trying to hide it and then getting it thrown at you later. Fronting up is good, but and I was looking at my notes, and as we were just going through, and it's exactly that. I believe we've got to make it easy to read. We need to front the things that are there, perhaps that aren't so pleasant, but also express the good news within it, what's there as well. And that should be the first few lines, the same comment about the mayor's preamble to this, etc. That's where people pick it up. There are some people that are going to get this document and sit down and go through the whole lot, but there's a lot that are going to pick it up and you'll lose them in minutes because, they don't like what they see or don't understand what they see. So to me, I think it's really a large part of what Stuart's saying is, hey guys, sell this thing and front up what we've got. That's all.
Thank you. Councillor John.
Yeah, thank you for that. One thing, the auditors may have a different view on this. One thing that makes it really hard to look at this to me is the fact that we do an annual plan and that follows a series, and we do an annual report that follows a series, but we never actually say how our annual report has done against the annual plan. It would be really good to have a column in there that goes alongside the actuals, what we promised in terms of the annual plan. So people can actually see how we've done against our plan. You can't do that with this document, and there may be legal reasons or other reasons why we don't do that, but I think it would be really useful to show people what we do if we actually put the two together. I'm very pleased to see some trend information on here. That's very helpful. One money question I was going to ask is on page 125. It shows that our water metered revenue fell by half, but I'm guessing that'll be a timing issue, is it?
Through the chair, so I spoke to that in my sort of opening notes. Yes, there was an accrual that was taken into the prior year, so the last year was overstated and this year's effectively understated because we've taken that money in earlier, but the funding that goes to the activity is in fact correct.
Okay.
Were you going to answer the budget questions? I mean, the budget columns are in there.
Yes, they are. Yeah.
So there's budget columns in there, which is effectively the annual plan numbers.
No, and there's some requirements, and Audit might be able to speak to this, where we have to, have a different reference point. But I will sort of note what's been said today. We need to provide an updated copy of this now for adoption by lunchtime, no later than lunchtime on Thursday. So the ability to turn significant amount of changes through. I will focus on the big things. I will focus, as Stuart's pointed out, around a comment in the Mayor's report, something up front in terms of our financial position and our rating loss and that management, which will now be, Jonathan will be talking to how we're tracking and monitoring that through our quarterly reports moving forward. But certainly, when it comes to those graphs and where we do have those gaps as a result of our rating deficit, we will look to make some more comment.
Councillor Marybridge.
I'd like to ask a dumb question. 2 years ago, we were $30 million surplus, and we've deteriorated so badly since then. How are you going to actually explain that to the community in simple terms so they can understand the predicament that we're in?
I would be interested to know which year we're actually talking about, Margaret, because in each year there's different things going on, whether it's a revaluation, whether we've got some subsidies that are coming in, etc., etc. So it's not a deterioration of our financial performance, although we have acknowledged that this year was a difficult and challenging year. But each year is comprised of different funding. So some of our funding for our capital projects comes through as revenue. That will mean that we have a different financial position in that year. So I'm happy to talk to any councillors about any because we've had a comment also from Don today about a particular situation that you would like me to work through with you. But it's not necessarily a declining financial performance. Yes, we've acknowledged that there has been some challenges in the current economic environment as a result of inflation, as a result of decline in building activity, which we're working through and putting a management plan around. The ultimate aim for a council is to have a balanced budget, not to make money, Margaret.
I do understand that, and sometimes we've had a surplus because we haven't done the capital work that we intended to do, and that can be a predicament as well. But in layman's terms, being able to identify and talk about, through the Mayor's report and our annual report, the issues that we've seen and experienced, we've come a long way. And in days gone by when we had the global financial crisis, and hearing about Mike Williams, I'm not quite sure that we need to actually assess everybody's performance who's gone before us. I just don't think that's necessary. Councillor Thwaites? Well, the lovely thing was, yes, so sir, I need to know that we can explain it simply to the community and not fudge it in any way.
Right, so that's all the questions. Any comments from Anton or Leon? Or...
Kia ora, Chair. Thank you very much. I'll make a few comments. We're still busy with our audit, so unfortunately I can't give you any clearance. But I did enjoy this discussion because one of the things we are also quite keen on is for annual reports to be understandable by readers, because in the end it'll be the councillors, a certain number of the management, and the auditors reading the annual report and no one else. That's a waste of paper. So for us, I completely agree that council can be more clear and in plain English, but that'll have to be, unfortunately, in the what we call other information, which includes where the mayor's message is. The financial statements, the statement of service performance, unfortunately, have to be provided under GAAP, generally accepted accounting practice, which includes the accounting standards. And that's very prescriptive, and of course the Local Government Act. I've heard a lot this year about Survive to 25. And to be honest with you, sitting here in December and still not having this audit completed is we're not far off, so I'm not overly concerned, but I think everyone is tired. Council staff are really tired, and I can see my staff are tired. And I just hope for next year, when we don't have any LTPs, no deferrals, and we'll get back on track and sign this audit off by the end of October for you to adopt within your normal statutory time frame. That's me, sir.
Thank you. Grant.
Well, just Adele, your summary that you read out at the start, is that have we got that on a document somewhere?
Through the chair, I mean, we're looking to include some of that key information now that we're getting to a settled position with audit into the Mayor's report, and as I said, we'll include some further comments in the annual report itself. Those comments will be included in the covering agenda.
I can go and watch the live stream again, but I just thought it would be handy to.
All right, so we have two recommendations there. The annual report be received and subject to any final audit changes, and that it be presented to the council meeting on the 12th of December.
Point of order, Mr. Chairman, do we want to comment about making minors or amendments or something like that? Because it talks about further and final audit changes, but we have anticipated making editorial amendments.
Through the chair, that would be useful for us, so we don't have to come back with every little minor word change.
Yeah.
Thank you.
So we want that as a number 3, the Chief Executive.
Delegate to the Chief Executive.
Yeah.
Number 3. Minor editorial changes. Or major ones in case. Right. Okay, so there's three recommendations then. Councillor Daly, Councillor Thwaites.
Yeah, you're working close. I was going to have one final say, just in response. Can I have one final comment?
Yes.
I would draw councillors' attention to the statement of cash flows, and although I've had lessons on accrual accounting from some of my colleagues, that is one of the key documents to read. And when you look at it, the net cash flow from operating activities last year, 34.2 million. Net cash flows from operating activities this year, 31.4. $2.5 million moved, but sitting right above that is an increase in interest paid by 2 million. So if you're comparing last year with this year, that's one of the most critical things, taking all the other magical accounting activities that go on. If you really follow the cash, that is one of the key documents. So I just wanted to make that input now. Page, well, statement of cash flows. Rodney's heard me talk about before. It's the only page I ever read. Follow the cash is a big part of it. Yeah. Sorry. Oh, happy to move anything you want. Yeah.
All right, so we had the three recommendations moved by Councillor Daly and seconded by Councillor Murray-Benge. All those in favour? Aye. Against? Carried. Right, thank you, Leon. Anton, appreciate your time. Thank you. All right, we're back onto the main document. Page 29. Darren, you up for this? Page 29 of the main agenda.
Kia ora team. So overall we've had a really good quarter with a number of our people metrics trending in the right direction. However, you will note that we had a bit of a blip there with high level of absence during that September quarter, so that bumped our absenteeism rate up quite significantly, and that was the highest that we had throughout the year. We had a wee chat to a few of our team members to see what was going on, and there was quite a lot of sickness, viral sickness going through the business. COVID ripped through the people team, so just generally high levels there. So that was quite a spike from that perspective. All other key metrics that we monitor quite closely are trending quite well, and particularly in terms of those turnover rates, which we've been monitoring quite closely for a long period of time now, as we hit quite highs post-COVID of 20%, etc., which was pretty difficult. But that's now plateaued, and we're trending really well in those spaces now, so that's been really good. The work program continues in the people space to be quite progressive. We've got quite a significant program of work in there. One of the key projects is actually the replacement of our foundation HRS system. So that's progressing well and on track. And that's one of those sort of core functions, core systems that we operate our whole employee data and information off throughout the employment life cycle. So it's a really key initiative for us, and that fell out of the FRO program of work, so that's continuing well. So from a health and safety perspective, another reasonably quiet quarter. There was no significant events to report for the period. We continue to focus on our four critical risks. We're doing deep dives into that, ensuring that we're doing everything that we can to mitigate exposure to those risks, or when people are exposed to those risks, that they are well equipped to handle them. And as you see, we've presented in quite a bit of detail in the past and come to you a number of times on the antisocial aggressive behaviour element of that. We're building a regular cadence with the executive team, who are really interested in playing more of an active governance role across our critical risks in that space. So we're building a cadence into our yearly cycle where we review those more regularly. We'll be coming back with a bit of assessment the next quarter on the health and safety maturity. We're taking a bit of a deep dive across the whole system there. And we've had some recent audits conducted in the infrastructure area, which we'll be able to report back on and give you a bit of a health check in that space as well. So we'll be doing that. We'll also be introducing some benchmarks. I know that I've presented a lot of information to you about our current performance, but there's not a lot of external benchmarking material in there to go, okay, well, what does good look like for council and for when compared against like councils and the market in general. I think that's probably a reasonable summary today. There's nothing of note that I've got here to talk to you today, but I do realise that this is a slightly different report than we've presented to you in the past, so I'm happy to field any questions.
One from the Mayor.
Thank you. It's a good report, so thank you for that. I'm just talking to the issue around managing confronting situations and the training that staff have been given, and that's great to hear. I just wonder, can this training be offered to elected members, either like during the term or perhaps during the induction next year? Because we're very much on the front line, like some staff members are. And there are certain members around this table who have felt that quite sharply very recently. So is that something that can be considered?
Yeah, we definitely can arrange that for you. Yeah. I'll just need to know where the budget's coming from, that's all.
Dora.
Sorry, I didn't hear you. I just had a question around due diligence. So it says that contract managers continue to conduct performance and review meetings. Is that just where you bring in the contract, you both look at it together and go, yeah, I think we might be achieving this? Like, do we actually go out and actually visually see what our people are doing?
Yeah, so that's the primary driver around exercising our due diligence, is actually to go out there and ensure that what we've agreed to in terms of the safety standards are actually being implemented by our contracting partners. So we've got a program of work we were developing. We'd like to see our maturity increase in that space, but that's exactly, yeah, you're correct about that's what it's about. So what we're looking to do is increase the number of proactive engagements around safety checks in terms of our contractors and that sort of thing. But in general, for everything that we do. So we've implemented programs around checks for our vehicles, for instance, and just being proactive in that space. So due diligence is all about front-footing things, and that's where we'll be working towards. Yeah.
Chair, hi Darren, and I was just wondering, in terms of the staff turnover, is it broadly representative across roles, or are there some noticeable spots within the organisation where we've got a lot of turnover?
Yeah, no, I haven't noticed any specific hotspots, but there are areas of the business where you do expect that turnover is naturally a little bit higher. And some of those areas tend to be our customer-facing roles, which is not uncommon for there to be reasonably high turnover in those areas. And also, which Rachel probably doesn't like me saying this, they're really great feeders for the organisation. So they come into there, they get a lot of valuable experience within the organisation, and they move to different roles. So we have a lot of movement in that space. So.
And the other one was just more in terms of the deep dive that you're doing, something that's come out of last week's court ruling in regards to Tony Gibson, the ex-chief executive of Ports of Auckland, who's been found guilty, and my first read of a Simpson-Grierson review has indicated that the reason why he has, when other similar situations in Australia haven't found the chief executive liable, was that the procedures weren't in place. And that's going to be, I think, on just about everybody's mind, and we've got to protect our chief executive. So I think we need to, there's a lot of chief executives of organisations, and in particular councils that are going to be very, very worried about that court case. And so that deep dive is really going to have to get into the nitty gritty of the actual procedures around the issues of safety in particular. And that's going to flow on to our relationship with contractors as well, just in terms of making sure we're doing what we say we're doing in terms of the procedures.
Yeah, and ensuring that they're also doing what they say they're doing. You know, this kicks off through right at the very beginning of the process of engagement through our procurement and our contract engagement. You know, that's where the conversation starts around health and safety, and ensuring that the right measures are in place to ensure that our people are safe and our community members are safe. It starts right at that point.
So will this deep dive be coming back to this committee at the next committee?
Yeah, we'll provide an overview of some of the information that we've received today.
Yeah, so I just wanted to comment. So just underneath that due diligence is audit and review. So part of that review is essentially talking about what you're mentioning. So we reviewed our contract management plan process. So i.e. The biggest thing you can do when you're managing a project is you're reviewing the contract against their management plan that they submitted and basically saying, have you done what you said you're going to do? I.e. your toolbox sheets, have you licensed your people, have you done the training? So basically that's in my view, the bridge between what we are required to do as council officers in terms of keeping our contractors accountable and also keeping ourselves safe in terms of saying that we are actively monitoring. So a lot of that part of that audit and review with an infrastructure was to check to see, are we doing that? How well are we doing that? And what is our risk profile? And so a lot of that directly relates to our engineers reps and contractors reps as well.
Thank you.
Thank you, Mark.
Just how do we cope with people who aren't performing? Is that part of your responsibility as well?
Performance management is part of everybody's responsibility, and first and foremost, it sits with that relationship between the people leader and that team member as a first port of call. So really what our kind of focus is from that centralised function of expertise is ensuring that all the tools and resources are readily available for people so that they have a good understanding about what good looks like and they can participate proactively in what good looks like. So it's all about making it nice and easy, making sure that people have the right knowledge, information, tools and understanding. And it's really important that we're clear about those expectations in those spaces and that there is a level of accountability. So all those people leaders who manage our kind of critical risks and general risks across the board, they are doing a fantastic job because they are owning that risk. Look, I'm not owning the risk on a day-to-day basis. The risk clearly sits with those people who are engaging the contractors, who are looking after team members. So, yeah.
Councillor Cox here.
I probably should have asked this before when the insurance expert was on, so it might be something that needs to come back, Adele, perhaps through you, if you don't mind. But my question is, and the question's been raised because of what happened in Whangarei Council recently. They had a majority vote not to implement fluoride, even though they've had a directive from the Minister of Health, or Director General of Health. And so they've been told, because the fine is upfront $200,000 and $10,000 a day, that they could be held personally liable for that. So, and whether you voted for or against, I guess, came into it. An abstention perhaps meant that you weren't liable for the decision. However, I remember asking this question when I first came on board, being a director of a board before, do we need to have professional indemnity as councillors? And probably wouldn't cover the scenario I've just talked about, because if you're acting against something that's been directed, even though deemed unlawful, where do you sit with that? So it's quite a complicated question, but I'd be very keen to understand that. Does anyone know?
Very briefly, it is our responsibilities and ability to take responsibility is detailed in the Local Government Act. That doesn't mean that I'm going to start explaining what that means in legal terms, but it is our broad brush outlined in the LGA. So
No, I'm aware of that, but I was told we do not need professional indemnity and cover in this role. But I'm wondering if we do.
I'm not sure I can answer that. But, yeah.
Leave that to staff to come back with an answer. Yep. All right. Okay, so we have a recommendation that the People and Capacity Managers Report be received. Thank you, Deputy Mayor and Councillor Sol. All those in favour? Against? Carried. Risk and assurance. So, you can handle that? Jonathan's going to handle it. Right. Page 44. Thank you, Darren.
Just introducing the risk and insurance report, which Peter has kindly authored for us, just to bring some key points through to it. So I'll assume it's read. So, excuse me, strategic risks. So just quick update on those. So again, continuing to look at the local waters done well, with the upcoming legislation next week, and also the Resource Management Act. So that's just keeping a close watch on where those are heading, and risks may change in our assumptions as those are produced, and also the ongoing impacts from the economic downturn that we're slowly moving our way out of. Recent inflation changes, along with the OCR last week moving to 4.25, will certainly help those risks, but continue to be a watch in this space. Also, there's reference in the report around the capital program, which you've all heard recently about being on track, and commitments and contracts in place in that space. So reducing those risks at this stage in that area. I'll take the report as read. If there's any questions on that or on the KPMG document that's attached, happy to take those.
While I'm thinking of the questions, I have a couple. Number 4 on second page, about the termination of the water care contract for the operational maintenance system and timely migration of data. So can we have a bit more background on that? That was looking after our servicing. Is that correct?
Through the chair. So yes, we had a contract with Watercare, and we were looking to, if the old Three Waters program was to continue, we were going to be upgraded into the new Info system. Watercare has now retreated back to Auckland and does not want to support the services here going forward. And so we have been looking for an alternative asset management system and GIS system, which is currently a joint contract with Tauranga City Council. We have got confirmation that we can continue with the existing product for 2 more years, but the risk is that something may change before then, and that's no longer supported. So we're starting to progress works on where we may go to from here.
Okay.
Sorry, I did have one link to the Watercare, which was just how material, how big is this in terms of roughly what's there? We've outsourced a service to Watercare. Do you know what that is?
I might refer it to Cedric. So there's one point is our asset management systems are joined, and then we've got contracts that are joined in terms of Downer and other things. So.
Through you, Mr. Chair. So, yep, no, Adele's right. So we've got a joint contract for our maintenance, so responses to leaks, and then the system we're talking about is basically a database that records all your work logs, your claims, has all your house's database in there. So I think part of the Three Water reform, there was a desire to sort of have a consistent database or a consistent software throughout the country, like they do in transport with RAM. Yep. So there was a desire to do that for waters, but part of obviously that not going ahead and with the new local water done well, we've now had to look at renewing the system that's no longer supported by Watercare. So it's roughly, depending on what those things can cost, around sort of $3 million to establish those, but that would be a joint cost. And then a cost that would be shared across, obviously, because it supports your capital program, it supports everything in terms of your delivery.
It's been costing us $3 million a year.
No, just in terms of setting that up and then whatever the cost is of running it or owning that software license. But I'm not sure what that is, but it roughly costs around 3 million.
Is it going to be, I know we're going to be talking about it further today, in terms of the ERP system that you are upgrading at the moment, will it be including in the jigsaw puzzle, will it be including water?
No, it's completely separate.
Okay, so
the system is essentially very operational. So it's essentially about pipes, dispatches in the ground, i.e. there's a leak over here, that'll be linked with a maintenance cost centre. So it's very much an operational tool rather than, and probably the easiest way to think about it is it's instead of using paper out in the field, you're using a database.
Hey, can I just say something that may clarify that for you, Stuart? We don't outsource anything to Watercare. We just have borrowed and pay for rent part of their system. They have said that they are no longer going to continue to rent parts of their database, their system, which is in the cloud, to other councils. They're only going to focus on themselves. So we just have to find a replacement system. 2 years. It is 2 years.
Yeah,
right?
When July 26th.
We're just trying to work out what that may mean if, depending on what our final waters model is and who's going to be responsible for that. Any replacement of the system or to stand up a CCO, if that's what we decide to do, we will loan fund and pass that debt on to the new entity.
Okay, I've got a couple more, but the Mayor's got one.
It's just been answered actually, I think because it was against what I'd heard about Watercare. You know, they're not retrenching from offering services. They actually pitched to Chatham Islands of all places to do their water services. So I was going to ask why they're retrenching, but it sounds like it's a much more niche system rental, as the CEO said. So thanks.
Okay, so my second question was in the list of risks spelled out below and all the tables there. I don't know what heading it comes under, but where does the Bell Road development fit into all of that in terms of risks we're looking at? I mean, I don't know what category it would come under.
Through the chair, are you talking about, so is it project risk versus strategic risks? So, I mean, we're obviously identifying the risk through the project's monitoring and, you know, that's in the covering report with Cedric. If you're looking at other, like fast track, you know, for example, you know, might be something.
I think it isn't covered in here. I think it's a good point. I think the whole growth and financial sustainability question is what we're talking about really in terms of what our priorities become as we move forward, what we had previously recognised under smart growth versus what Crown might be recognising as priorities, and how we, obviously we can't afford everything, so how we're going to make decisions about where we're going to spend our money on that infrastructure. So I think it's a good point, and we need to include it in our growth and financial sustainability type risks.
That's the page I put my note on, but I didn't know whether it was the right page for it.
Feels about right. And I think, and the reason I say it feels about right is because it's probably going to cut across a whole lot of parts of our business, but it's as good as any. So we'll take your direction on that.
And then the where's that under? Oh, the financial report. No, not that. Right, that was all my questions. All right. So we have a recommendation that the Risk and Assurance Manager's report be received. Thank you, Mayor.
Sorry, Murray, I got quite a bit on this.
Oh,
is it okay?
Yeah.
Couple of just in terms of looking at the ongoing internal audit, sort of, I guess, 3-year rolling plan that's being finalised. Could I ask that? I think that's coming back at the next. That will be coming back to the next Audit and Risk and Finance Committee. That it's going to probably need to be dynamic in the sense of its prioritisation, especially given the next 2 months the whole sort of progression of the local water done well will have I think, a really significant impact on that. And so we want to be able to be a bit nimble and not be steadfast in saying, okay, we're going to do a deep dive here, when actually there's going to be some stuff that's probably going to have to be mindful of that. So I just wanted to sort of put that out there a little bit to help management, actually, because otherwise, you know, we could be just focusing on the wrong priorities given what may occur over the next few months. Just in terms of that, because in looking at the update and looking at sort of changes and trends to our the overview of the risk arena, if I go to page 54 of the report, and so we're looking at operational risk, and I know that one of the big things that, and I've just kind of teased it a little bit when it comes to ERP and platforms and systems and IT, and a lot of the sector is about continuity and harmonisation. I mean, we shouldn't be reinventing the wheel amongst ourselves, councils, when it comes to this area of risk that can really impact on your operational risk. And I think that that would be, I just ask, and I know that John and the team have got this already covered, so I'm kind of preaching to the converted, but please excuse me for that. But in the options that you do consider when you're looking at the local water done well, it's going to be really good to know what our friends are doing if we are going to be with friends. And we're dancing on the floor with a number of different partners in the future, then it's really good to know that there's going to be potentially some upfront ideas of continuity and interrelationship between ERP and other systems. And that for me is an emerging risk. Just to say that that's kind of part of that consideration as we sort of move forward, because I'm sort of into looking at where the wind's blowing, how strong the wind is blowing, but where that wind's going to possibly take us. And so I'm just looking ahead in terms of this committee and some of the material things we'll be wanting to get a feel for. That's also going to be, I've already made a point about the health and safety, which I think is going to be, you know, a number of things around professional indemnity, and that goes to insurance, and that goes to everything else around these areas of changes of legislation. Risk 6, the debt management. I think it's absolutely imperative that our debt forecasts are dynamic. And I know that later on today we'll be talking about the Treasury report, and it's one thing that I'm really, really hot on, is that our net debt forecast, to the point of following the cash, tells us the real where we're going in terms of management of debt and management of interest rate risk. And at the moment we still seem to be, we're just getting one graph that shows us debt as per the LTP. Now I know that I brought this up and would really like to see, I won't repeat myself, I think it's part of this whole risk and looking at emerging risks, but you don't know unless you know what's happening on the dynamic debt front. And we know now, if we've spent in the last quarter what we said we were going to spend in CapEx, and we know now that the senior leadership team that are on the spike for projects and project timing are going to know whether or not the spend's occurring, or it's going to occur on time. But we need to know this, Adele needs to know that information every month. What's this looking like? Or are we just, rolling to the end of the year and get a nasty surprise? So I think that was my key point in terms of risk 6, and in terms of looking forward, especially when we're seeing which way the wind's blowing. Page 69. Yeah, no, I can leave that one. I'll just make that as a separate point. Yeah, and you get to risk 8 and you get to risk 9, and everything's around this ERP replacement. And I know that is in the top 4 of many councils and actual organisations, that it can be a black hole. I've only known one. I've only seen one example where things have gone to budget in relation to that and timing. But that's probably the one of the biggest emerging risks, whichever way, whatever happens with regard to the local water done well. That's going to be really important for this council going forward. Yep, that's it for me.
Okay, thank you, Stuart. Right.
Can I comment on that? Because I think it's really important. And Stuart, you made the point before about being flexible or dynamic or something, with so much going on. And I think it is one of the real issues that we face at the moment. I mean, everyone knows that our systems aren't fit for purpose in terms of being able to just push buttons and get numbers out that we want. And we're heavily reliant on some pretty antiquated systems that let us down. And the trickiness, I guess, that we have is that, in the next 6 months or so, we still need to, we're finishing the annual report today or thereabouts. We've got the annual plans to do, we've got waters to do, we've got a whole of organisation to do. We don't know what the rest of the organisation is going to look like after we potentially lose part of building consent or RMA and all these other things that are happening, right? So there's so much going on that is such a heavy call on our finance team, because no matter what change you're doing, it requires some sort of financial analysis, and it's normally overly complicated. We haven't got the systems to support that. We want to change the system so that we're better, but it's really hard to actually then take staff out of the business to work on something like ERP and have them focused on that when we've got all that change going on as well. So not throwing you a problem, just providing some context around that. It's almost a damned if you do, damned if you don't, get on and do the ERP project.
It's also very hard to scope the project when you don't know what the final organisation looks like.
Yeah, I think the modularisation, if that's a word, of these systems will probably cope with it. But yeah, I agree, mate.
And just through the chair, just in conjunction with your comment, Stuart, about considerations of other platforms of potential, people that you might be pairing up with, the only constraint that we have at the moment is, for example, Tauranga use the largest system being SAP, which is effectively unaffordable for this council as well. So as much as I do agree with you, there are other constraints, and we're trying to weigh up a whole lot of things at the moment.
I'm sure it's not a case of buying a system off the shelf, but how much customisation do we need, bearing in mind we're a mid-sized council?
Through the chair, we ultimately want to stick with the product as cleanly as possible. We do have a 20-year bespoke model. That's the stuff that's causing us grief now, because we can't just go and do an upgrade. We can't just go and make some changes readily, So yes, we've got some philosophical baseline agreement amongst the team about how we're going to start and what we want moving forward. So it's been very clear in, on the documentation and our requirements moving forward.
Good.
Sam Broughton talked about this at the local government conference, and surely there must be, this is a New Zealand-wide problem with however many councils we've got, 67 or whatever. Surely someone is working on something that can be universally applied to all the councils and customised individually, or to incorporate historical data or whatever. But where are we at in terms of central advice?
Through the chair, so one of the big deliverables for the, under the old government for the Three Waters was a single IT system to operate that. Unfortunately, no one could keep that going enough to have it available to all other councils moving forward. But we are looking at what we can use from that suggestion in that space. But certainly there are only a limited number of local government IT systems that are available, so it's not like it's a wide pool. But yeah, there's certainly some opportunity nationally to think about those things.
Councillor Thwaites.
Just following on from Stu, reading next week's Tauranga City Council agenda here, how in their Three Water space, how they are going to rescind their 20th of May decision to, their preferred option was to set up a CCO with Western Bay of Plenty, and now they're rescinding that, and now the first option is to set up a CCO with a debt, what's the wording here? With a debt capacity council, whoever they may be in a CCO, and if they can't find a debt capacity council, to set up one on their own. So they're certainly moving a lot faster space than we are with their published agenda here now.
So who was that?
Tauranga City Council. It's all on their agenda for next week's meeting here. So they're looking for a debt capacity council now. They've rescinded Western Bay being in the original topic. Whether we come back in and meet that criteria, time will tell, but it's certainly interesting reading right on Christmas. Thanks. Page 217 of their agenda for next week. Well, that's what they want. Someone with a lazy balance sheet that they can rate, because they haven't got one. They've got a hard-working balance sheet.
All right, well, back onto our agenda rather than theirs. We have a Risk and Assurance Manager's report to be received. I think I had to move it, didn't I? At one stage? No? Right. I need to move it in a second. Thank you, Councillor Murray Benge and Councillor Sol. All those in favour? Right. Against? Carried. Right, financial performance on page 73. And back to Adele. Jonathan, right.
Yep, thank you again. So just introducing the report. I'll take it as read and run through some highlights. Firstly, just noting that the budgets in there are as per the adopted annual plan. And as we move and need to rephase some of those budgets, those numbers may change. So we're just working through with budget managers in that space just to make sure it correctly reflects the performance of the year. If I firstly touch on the numbers on page 74, so the revenue there and the big variance sitting out to the right of the 12 million, that is mainly driven by an 11.9 million delay in a claim to do with the Makaroa structure plan, so that's in our transport activity. The way that those claims work is we need to reach certain milestones before we can make those claims, so that is just a timing issue. And as we hit those milestones, then we can make those claims and that revenue will come in. In terms of the total surplus deficit, that is, again, is the main driver in that area. Just touching on the balance sheet as we move down through that page. We've got a lower borrowings level at the current point in time and a higher receivables level, and that's the receivables due to the later billing, the rate strike in September. So at that point in time in September, that's when everything started to become due from a revenue perspective.
Just a quick question on the transport subsidy. Any idea when that will come in? That, yeah, I presume it'll write itself fairly soon.
Cedric, did you want to comment on that?
Is that the KO subsidy or the actual? So basically, we've got milestones throughout that funding at different stages, i.e. When you've procured, when you've met your earthworks. So I'd have to go back and have a look at that milestones, but as we are slowly ticking it off, I'd expect probably to be a big claim in probably February and March.
So yeah, so we are on track to catch up this year.
Yeah, it's always just the relationship of applying for the funding well and truly in advance of your procurement and developing your program.
Sure.
So often you need to reset your milestones, whether it's a CIP or NTTA subsidy to align.
At least the power poles have been moved now, so it helps.
Yeah.
One thing we have talked about in the finance team is how we can accrue for some of those subsidies. So we're meeting partway through those milestones. So that would remove some of the noise when we are actually getting the activities done. If I just shuffle down to the formal finance report. So on page 78, with some metrics in that there. So coming back to the discussion earlier on debt to revenue ratios. So at the end of the quarter, we were sitting at 68% in that debt to revenue space compared to a budget of 98. Since that point in time, we have had more drawdowns, again, due to the later rate strike and not having that cash in the bank. But we're now in that position where in a couple of weeks' time, we're starting to repay some of that very short-term debt that we drew down. Again, when we hit those more detailed numbers, the big numbers that stand out are the subsidies and grants.
So on page 39, it shows the personnel costs are running $250,000 above, but on page 84, it says, as part of our program to sort out the deficit from last year, that we've saved $500,000. So how do we reconcile having saved costs of $500,000 in the page 84 on that sort of reconciliation with being $250,000 above budget in the main financial statements?
So in the tracking document, what we've done is to ensure that we do make those savings, that we're reclassifying $2 million for the year of that personnel budget, taking it out, putting it aside for decisions where ELT now need to make decisions to reuse any of that pot. So it's locked away. So that $500,000 per quarter is locked away. The $252,000 is saying that with that removed, we are over for that period.
Yeah, we're still working on achieving the savings.
And we've still got lever accruals coming through there as well.
Sorry?
We've got lever accruals coming through there as well.
That's always fun. One thing that I should have asked at the time is that, I know we're holding vacancies open and managing this, but do we have a sense that, once we stop doing that, we're going to stay within budget, or we're just going to, what's the run of the personnel cost line? Are we, really in a sustainable plan versus what we've projected once we've made these savings as a one-off, if that makes sense? What's our run rate on personnel cost versus our short-term savings plan?
I'm not sure whether it's going to completely answer that. I think we need to carry on as we are and making good decisions about where we can afford to compromise on some capacity. Is it enduring? No, it needs to dovetail into the other work we're doing around life after water.
I'm happy to take any questions.
Can I just comment before we take further questions? So I just wanted to reiterate the conversation this morning in regards to regulatory. The way that it's presented at the moment has revenue separate from the expenditure of regulatory. So as I've spoken to this morning, it is a net deficit position at the moment, which we are actively managing. But we will forecast another deficit is likely in the current year unless things turn around very, very quickly. And sorry, if what we're doing, that's why we've over-targeted for the current year's requirement to cover off, where possible, the additional needs.
Chairman, just so I can get my head around it, Adele, if we follow on what we're planning to do, we can come back into a sensible space next year. But at the same time, because we've got the three waters done well, that adds to the confusion of where to from here. Am I wrong in thinking that?
So we're doing some work at the moment in the preparation for the annual plan discussion with council in terms of where we see the regulatory function and its income and what's happening nationally and then what it means to us locally. So that is a piece of work that's happening. In terms of local waters done well, there is a separate piece of work which we need to deliver by the 2nd of September next financial year. We have to deliver to the Department of Internal Affairs a local waters done well or service delivery plan. As part of that process, we've been meeting with council and progressing the requirements of what that plan will look like. And to Councillor Thwaite's point, we will need to consider what the best option for this council might be. And so that's what we're progressing the various steps with our consultant and providing that advice. And there will be consultation that happens next year in terms of our preferred way forward.
Can you remind me, when do we get the final report? Done well.
The final meeting at this point in time is 29th of January.
I know it's talked about here as being a phasing question, but I see there's been some, you've turned over the vehicle fleet. I'm just wondering if, quite apart from the timing question, have we achieved any savings? I know once you and I talked about fewer vehicles or whatever, have you managed to get us any savings from the regular turning over the fleet?
We're actually looking at that as one of our operational savings at the moment that we'll be bringing back as part of the annual plan for next year to slow down that turnover. It's a balance between that and maintenance and sale cost, right? But sometimes you just have to hold for a bit.
Oh, yeah, just to confirm that in terms of the timing differences around CapEx, is there anything that is in the current budget that might not see the timing difference occur in this current financial year? So anything that's looking likely and highly likely to get pushed out beyond 30 June?
No. No, and just to reiterate it and use my words rather than Cedric's, because he'll, it's nice to hear another voice. The capital program is going incredibly well. All but one of the larger contracts are now let. There's 2 or 3 smaller ones that we still need to work through, so we're really confident. I mean, you can only, what can you control in these processes is getting to tender, getting to market, finding your partner and letting the contracts. We've done that.
Yeah.
So, Sue, one of the things I asked this morning, we had the email from James to tell us what Smart Growth was going to do. So Smart Growth is doing research for us that we wouldn't have to do. Is that correct?
No. I mean, they're a planning organisation. They do plans. They've done the strategy. There's other plans coming up, but it's not research as such. I think that's an odd way to look at it. So what point are you trying to make? I don't understand.
I'm just trying to understand the reasoning behind that decision.
Sorry, the decision to?
Recommendation Smart Growth is going to be doing. Linking with the central government changes that are coming through.
So, The confidential email that I sent.
Oh, good.
Yes.
We're not in confidence now, are we?
No.
I have a question, Murray. Just one more question, and it was just in terms of page 87 and the chart, centre chart that shows the current funding and risk profile, and noting that we've got pretty well most of the council's interest rate cover is in that 0 to 5 years, and that at this stage there is no interest rate risk management occurring in terms of 5-year plus. What's I know that this is Bancorp is recommending at this stage not to be in that bucket, and that's they're our advisors. But do they have a strategy or a target that they could share with us? Is there a level where they would be pushing the button to say, hey, council, you need to look at some long-term cover at this level, for example, 3.5%, or, I mean, is there a target, or is it just wait and see at the moment?
Yeah, so the discussions we've been having with Bancorp have been around establishing what that debt picture will look like going forward.
Mm-hmm.
So a significant amount of that debt belongs in that waters activity and bucket. So once we've got clarity around what that may look like, then we can split this out, look a bit further. But no, we haven't got a specific measure for that 5-year plus window.
Is that because of the debt that's linked to water?
Yes. So
right.
Majority of our debt is linked to waters.
Because I understood that if every way it goes, that councils had learnt the lesson of listening to the government in regards to the very first issues around and the uncertainties of debt because of the first Three Waters program and legislation. But there was always a make good, shall we say, provision in relation to the fact that you've still got to run, you've got to run your debt and your assets on the basis of you still being a council that's operating, and I was my understanding that even under the new, and certainly under the new local order done well, that there's going to be an ability to shall we say, transfer those sorts of decisions into the ultimate vehicles, i.e. don't stop now because we haven't made up our minds on how these things are going to split out. But at the same time, those assets haven't gone away, the debt hasn't gone away, it still needs managing. Is this conversation happening?
It is, yeah. So we've had this conversation with Bancorp, and what we've been targeting to date is getting in line with our policy minimums. So that's been the focus. And so over the last 3 months, we've picked up 45 million of extra cover as those rates have come down. So those conversations will now continue. Most recently with Suresh at Bancorp has been around, let's wait and see if there's a decent opportunity for those further out yields and curves, then we'll consider
it's that decent opportunity I'm really keen that we get a feel for. I like to know which way the wind's blowing. I'd be very interested to know what their recommendation is. Hey, our view is that levels under X would be target levels for this council and make sense, rather than it's kind of a bit ethereal to say, well, waiting for what?
Yeah, no, understand and agree, and that's something I can raise.
I'm trying to get a feel for that. I'm not questioning the management and your advisors' advice for the here and now, but I'm really keen to know a strategy.
Yep.
Would that
Yeah,
be
that's
able?
something I'll bring up. We've got a meeting next week
I
with
mean,
Bancorp.
it would be fantastic if they could, if I could through the chair, I'd love them to give us a presentation next year around these sorts of thoughts, what their ideas are, what their strategy, where the game plan is. Be really fantastic to hear that, because it is going to be such a big material component, you know, that impacts whichever way we look at it, the going forward of this council, and certainly in terms of cost of funds.
Yep, absolutely. No, I'll look through the chair to invite them to the next meeting and work out a strategy. And by then we should have some more certainty around waters.
Thank you.
Thanks.
Sorry. So that's all right. The important people heard what I said, so that's all right. Right. Right, resolution to exclude the public. Thanks, Councillor Coxhead. Councillor Murray-Benge, all those in favour? Aye. Yes, carried. Rightio. Enter confidential. Are we all done, Horaway?